The shift in Trump's 401k policy, essential insights for administrators and employees. President Donald Trump's recent executive order has sparked significant changes in the landscape of 401k plans, allowing for the inclusion of alternative investments. This move could fundamentally alter how millions of Americans manage their retirement savings. The executive order, titled Democratizing Access to Alternative Assets for 401k Investors, outlines a framework for integrating various alternative assets, such as private equity, real estate, and cryptocurrency, into retirement accounts. While this order does not, Will Dunham, president of the American Investment Council, a trade association representing the U.S. private equity industry, stated, "For decades, public pension funds have invested in private assets because they deliver strong returns over the long term and are a smart, safe way to diversify retirement savings." President Trump's executive order is a significant step that will enable all Americans to enjoy the same benefits of enhanced returns and a secure retirement. However, this shift is not without its critics. Some experts argue that retirement portfolios should be managed conservatively, expressing concerns about the complexities and risks associated with alternative investments, as well as the potential for higher fees that could diminish savings. Economist Gopi Shargoda, director of the Brookings Institution's Retirement Security Project, cautioned, "Alternative investments are typically less liquid and more volatile, meaning that investors may not have immediate access to their funds and could face increased risk. They also often come with higher fees, which can erode the returns we discussed earlier." In a conversation with Newsweek, legal experts and private equity professionals shared crucial insights for both plan participants and those managing these plans, highlighting what they need to know before diving into these new investment opportunities. Key considerations for administrators. Simon Tang, director and head of U.S. operations at Acolex, a fintech firm specializing in private markets, emphasized the importance of addressing the transparency gap. He explained, "General partners of private funds are committed to maintaining privacy and confidentiality regarding their investments in private companies, which is a competitive advantage. However, retail investors expect the same level of clear and timely information that they receive in public markets and even in cryptocurrency, where private equity often falls short." To close this transparency gap, Tang suggested that administrators invest in AI and automation tailored for private markets to access, extract, standardize, and present insights to retirement investors. Failing to do so could result in losing these investors to competitors who can provide the necessary information. Bill Cox, head of corporate, financial, and government ratings at a New York-based rating agency, remarked, "Private markets are a source of systemic strength, and their democratization can benefit both retail and institutional investors when approached with proper due diligence and an understanding of their unique characteristics." He added that venturing into alternative assets requires careful consideration of liquidity risks, fee structures, and the critical importance of selecting the right managers. Cox further noted, "The variability in performance will depend more on the managers that 401k investors choose rather than the mere allocation to alternative assets. We anticipate that this differentiation among managers will become more pronounced over the next 3 to 5 years." Carol McLarnon, an attorney with expertise in the financial services sector, highlighted the increased litigation risk that plan sponsors and fund managers must navigate. She pointed out that certain law firms focus on filing lawsuits against 401k plan sponsors and financial professionals for excessive fees. However, she also mentioned that Trump's executive order instructs the Department of Labor to address this issue in its forthcoming guidance. Plan sponsors and employees interested in private equity but lacking expertise can consider pooled investment funds managed by advisors with significant experience, she advised. John Hunt, a partner at a global law firm, noted that the primary exposure lies with plan fiduciaries and the liabilities they face in deciding which investments to offer to plan participants. He stressed the importance of understanding the risks and costs associated with alternative investments, questioning how financially literate individuals need to be before it is wise for them to invest in such options. Tom Hogan, employee benefits counsel at a corporate law firm, warned that the higher fees associated with private equity could expose plan sponsors to fiduciary litigation. He explained that under the Employee Retirement Income Security Act of 1974, plan sponsors must adhere to a fiduciary standard of care and prudence when selecting or monitoring investments. Hunt also pointed out the liquidity and valuation issues that arise with alternative investments, as they are not easily sold or converted to cash, and determining the real-time value of private equity can be challenging. This can lead to inaccuracies and potential disputes or lawsuits from employees who feel they were not treated fairly. PESP also noted that private equity often reports returns in a manner that makes them appear more favorable than they actually are. Without clear, standardized benchmarks, it's challenging for plan managers to determine if an investment is genuinely worthwhile. What employees should understand. Simon Tang reiterated that employees should be aware of several concerns related to private equity investing, including higher fees, inherent complexity, and the unique return, risk, and liquidity profiles of this asset class. He emphasized that addressing these concerns will necessitate substantial education and data-driven knowledge transfer. Another critical risk to consider is asset allocation and portfolio construction. Tang explained, the general public is accustomed to depositing their paycheck into a 401k and selecting from various listed equities and bonds. Introducing private equity into this mix will require employees to assess their exposure and diversification goals, as allocating their entire 401k to private equity would indeed be risky. He added, anyone contemplating allocating a portion of their retirement savings to private equity should take the time to understand the nuances, advantages, and disadvantages of this investment type. They should also anticipate a very different experience compared to the instant pricing and real-time updates available in public markets. Rob Sickle, a partner at a global law firm, emphasized that plan participants must ensure they are investing in products that are prudently designed to function effectively within a defined contribution plan. This means understanding whether a fund has adequate liquidity, manageable fees, and is overseen by a fiduciary with the necessary expertise. Even if such an investment is included in a plan's offerings, participants should ensure that it is prudent based on their specific circumstances, he added. The Private Equity Stakeholder Project, PESP, warned, higher costs can significantly erode savings. Private equity funds typically charge much higher fees than index funds, sometimes with multiple layers of fees, and these costs accumulate over time, resulting in less money available at retirement. They also pointed out that funds invested in private equity are usually locked up for longer periods. You can sell a stock or bond fund any day. With private equity, you may have to wait years to access your money, and even then, you might receive less than you anticipated, they cautioned. Russ Ivanjak, Aon's Global Chief Investment Officer, added, for employees, this means potentially higher costs and reduced liquidity. Unlike public equities, private investments do not provide daily pricing or straightforward disclosures. Therefore, we recommend utilizing private assets only within professionally managed portfolios, such as target date funds, where trained fiduciaries are making decisions on your behalf. What lies ahead? As experts have noted, the executive order merely instructs the Department of Labor to review current regulations and guidance concerning alternative investments. At this point, there are no formal proposals, stated John Hunt from Sullivan Worcester. It's simply a directive for the DOL to contemplate and devise a plan, so there's nothing to react to other than the optimism surrounding potential changes. Simon Tang added, this is not an overnight transformation. Private equity will not suddenly be included in every 401k plan. While returns can be appealing, the associated fees are higher, investments are less liquid, and performance data is more challenging to obtain, he continued. It remains to be seen how this change will be implemented. Trump has given the Department of Labor 180 days to reassess guidance and clarify the government's stance on alternative assets, including private market investments, real estate interests, and digital assets within 401k plans.